Welcome back to the Deep Doc. Today we're jumping right into Payoneer Global Inc. That's ticker PAYO. They're a really interesting fintech player, kind of the financial plumbing, you could say, for small and medium businesses trying to navigate this increasingly complex global trade world. Our mission, as always, is to cut through the hype and the noise. You want to figure out what Payoneer really is. The stock's around $5.94 right now. Is it, an undervalued gem poised for growth in this new trade era? Or is it maybe more of a niche company facing some pretty serious competitive risks, maybe some internal problems too, that make that current price look a bit shaky?
And we should probably start right there with the central puzzle, the paradox that really makes Payoneer stand out, because fundamentally this company looks quite healthy. You've got an excellent return on invested capital, 18.8%, and the balance sheet is clean, debt-free, plus it's churning out free cash flow like crazy. I mean, the price to free cash flow ratio is around 10.5x. That's typically what you see with a classic, maybe deeply discounted value stock. And here's the kicker. The market is also pricing it with a price-to-earnings ratio of about 22. That looks more like a growth company valuation, right? So yeah, it's like market schizophrenia. How can one company look like both a cheap value play and a growth stock at the same time? We really need to unpack this disconnect and also look at some, well, frankly, conflicting signals coming from management.
Market schizophrenia, I like that. Okay, let's do it. Let's start unpacking by looking right under the hood. Chapter 1, business understanding. So Payoneer's whole philosophy seems to be talent is everywhere, but opportunity isn't. They act as this global financial stack, basically making cross-border payments less painful for businesses. I see kind of four main ways they make money. What's the breakdown there? And where's the really profitable stuff?
Well, the base layer, the foundation, is definitely the transaction and service fees, what they charge for sending and receiving money across borders, standard stuff. But the higher margin stuff, the real juice, comes from a couple of places. First, currency conversion, the spread they make on foreign exchange, the FX. That's usually pretty profitable for these guys. Second, and this is a big one right now with rates where they are, is interest income. They hold about, $7.0 billion in customer funds, and they earn interest on that float. Very profitable in this environment. And then the fourth piece, which is maybe more strategic for the long run, is their value-added services. Things like B2B accounts payable, accounts receivable solutions, their commercial MasterCard offering. Growing that is key.
And the platform itself is huge, right? 190 countries, 7,000 payment corridors. That's massive scale.
Yeah.
But they're up against giants like PayPal and also specialists like Wise, who are known for low fees. I thought their partnership with Stripe, announced back in August 2025, was pretty interesting strategically.
Oh, yeah, definitely. Instead of trying to build, a world-class checkout system from scratch, which costs a fortune, they decided to basically rent Stripe's technology. It's smart. It lets them focus their own investment on their core strengths. That integrated payment platform, the global licenses, the regulatory know-how, really digging into local market needs.
Right. And speaking of that global infrastructure, you mentioned external forces are actually sort of playing into their hands. These 2025 U.S. tariffs are shaking things up.
Exactly. That's the geopolitical tailwind. The tariffs are pushing trade away from that big established China to U.S. lane. So what you're seeing is trade becoming more fragmented. Supply chains are shifting to places like Vietnam, Mexico, India. It's becoming a much more complex multi-corridor world. And that complexity, that's good for Payoneer. Their whole value proposition is built around managing that kind of friction. They become almost like essential infrastructure, the picks and shovels for this new era of global trade.
That makes sense. It leads right into what you could call their biggest advantage, maybe. That regulatory moat. Competing with PayPal and Wise isn't easy. You need barriers. What's the crown jewel there?
I'd say it's definitely their access in China. Getting that local payment service provider license in April 2025, that was huge. They're only the third foreign company ever to get one. That license is incredibly valuable and really deepens their competitive advantage in one of the world's biggest and, frankly, most complex payment markets.
Okay, that paints a clear picture of the business. Let's shift gears. Chapter 2, management evaluation. Let's talk about leadership.
Yeah.
John Kaplan became sole CEO in March 2023. He came from Alibaba.com, right? But a turnaround there. And he seems to have initiated this strategic pivot at Payoneer, focusing on what they call ideal customer profiles, or ICPs. What does that actually mean in practice? Who's an ideal customer for them?
Well, it's basically a shift away from just chasing volume, signing up anyone. He's pushing them to focus on higher value, higher margin clients, quality over quantity. So an ideal customer is probably one who uses those stickier value-added services we talked about, or one who operates across multiple complex payment corridors where Payoneer can charge more and add more value. And you can see the impact in the numbers. Since he took over, over, revenue's grown at a 16% compound annual rate. And that return on invested capital, the ROIC, has shot up dramatically. It went from negative territory back in 2022 to that very strong 18.8% now. So yeah, the focus on more profitable customers seems to be working. The pivot is delivering.
Okay, but this is where it gets complicated, right? This crisis response paradox. They seem pretty good at handling the big systemic stuff, but maybe fumble on the customer level.
That's exactly the tension. It's quite glaring, actually. On the one hand, you see a commitment to high-level compliance. They voluntarily reported past sanctions issues, cooperated with regulators, which led to those fines in 2021 and 2023 from OFAC and the NYDFS. It shows they're willing to tackle serious systemic problems head-on.
Right. Millions spent on compliance systems, getting things right at the top level. Yet you'd look at somewhere like the Better Business Bureau, the BBB, what was it, 865 complaints in 3 years. And they're about really basic, painful stuff for users' accounts getting frozen, support just not responding. If the high-level compliance is so tight, how are these basic execution failures happening? It feels like a disconnect.
It absolutely points to significant operational weakness, and it's a real reputational risk, no question. The automated systems meant to catch regulatory issues seem to be causing havoc for actual customers. Building brand trust takes years, decades even. You can burn through that goodwill very quickly if your basic service fails people when they need it most.
It's a serious point. But despite that weakness, management seems very confident in the stock's value, looking at how they're allocating capital. They're sitting on, what, over $500 million cash and no debt.
Exactly. That financial strength gives them a lot of firepower, and they're using it for a pretty aggressive share buyback program. They boosted the authorization in August 2025 up to $300 million total, running through the end of 2027. That's management effectively saying, we think our stock is seriously cheap right now. It's a strong signal.
Okay, let's dig into those financials a bit more to confirm that strength. Chapter 3, Financial Analysis. Historically, yeah, that 5-year revenue CAGR at 25.2% is strong. But we do need to note the 2025 guidance around $1.05 billion implies growth slowing down to maybe 7.4%. That reflects the pivot and just, well, the law of large numbers kicking in.
Right. The focus isn't just top-line speed anymore. It's about the quality of those earnings. And that profitability inflection you mentioned, it's really something. Gross margin is high? Sure, 78.65%. But the operating margin turnaround is the real story. From negative numbers in 2021, 2022 to now being in the, 12.8% to 16.5% range. That's huge. It shows Kaplan's strategy is hitting the bottom line.
And that translates directly into strong free cash flow generation, which explains that low price to free cash flow ratio, the PFCF, down at 10.5. Plus, as we said, the balance sheet looks rock solid. Debt to equity is tiny, just 0.06, basically no debt.
Which loops us right back to that valuation puzzle we started with. You've got the growth multiple, PE, around 22.5x, sitting right next to the value multiple, PFCF, at 10.5x. Why the specific gap? Well, it seems the market is just skeptical about how sustainable those earnings are. Remember that big chunk of profit coming from interest income on the customer funds, $7 billion float? The market sees that as potentially volatile, right? Highly dependent on interest rates staying high. If rates fall, that income stream shrinks. So it discounts the reported net income, which pushes up the PE ratio relative to the underlying cash flow. The price to free cash flow, though, that just measures the raw cash coming in the door. And that cash generation is undeniably strong, hence the low PFCF multiple. The market trusts the cash more than the accounting profit right now.
That makes a lot of sense. A really fascinating disconnect there. Okay, we've covered the business, management, and the core financials. We see the strengths, the strategy, but also the tensions. Before we get into how the market is reacting, ownership, and the big risks, just a quick word. If you find these deep dives valuable, breaking down companies like this, then like and subscribe to Stock Analytics AI. It's just €4.99 a month. For that, you get full access to our playlist. Already got 500 deep dives covering all the S&P 500 stocks. And next up, exclusively for members, we're tackling the NASDAQ 100. Plus, members can request specific stocks for us to cover. Just drop the ticker in the comments and we'll add it to our list.
Yeah, it's a great resource. Okay, so back to Payoneer. We've got this fundamental picture, this valuation puzzle. Is the market buying the story, or is skepticism winning out right now?
Chapter 4, Market Sentiment. Well, this is where you see another big disagreement. The Wall Street analysts, they seem to love it.
Oh, absolutely. The consensus ratings are overwhelmingly strong buy or moderate buy, pretty much across the board.
And their price targets reflect that optimism. The average 12-month target is somewhere between $9.50 and $10.06.
Yeah, compared to the current price around $5.94. So that implies, what, over 70% upside? So analysts clearly see significant value that the market isn't recognizing yet.
But Then you look at the stock chart itself. The technical picture tells a very different, much gloomier story.
It really does. The price action is technically bearish right now. The stock's trading below its 50-day moving average, which is around $6.05, give or take, and it's significantly below the longer-term 200-day moving average, which is up near $6.40. That confirms the current downtrend from a technical perspective. Short interest isn't extreme, but it's a moderate, maybe 3.4% to 3.6% of the float. So yeah, the market seems hesitant. It's waiting for more proof, maybe.
Waiting for that fundamental story to translate into price momentum. Okay, what about who actually owns this stock? Chapter 5. Ownership structure. It looks like institutions have a pretty firm grip here, but then there's that insider activity that raises questions.
Yeah, institutional ownership is high. Somewhere between 71% and maybe 78.5% of the shares are held by big funds, pensions, etc. And it's concentrated too. The top 25 holders control almost 3/4 of the company. On the one hand, that can mean stability, committed long-term holders. On the other hand, if a few of those big players decide to sell, it can create significant downward pressure pretty quickly.
Right. And that leads directly to what you called the insider contradiction earlier. The company itself is spending potentially $300 million buying back its own stock.
A massive vote of confidence from the corporate entity using shareholder cash.
Exactly. But the actual people running the company day to day, key executives, even the CEO, they've been net sellers over the past year.
Yeah, the record shows something like 58 sell transactions versus only 13 buys from insiders. So while the company is buying, the individuals with the presumably best insight are selling more than they're buying. It definitely suggests some kind of misalignment, doesn't it? Or maybe just a lack of personal conviction that the stock is that undervalued right now despite the buyback. It's a signal you can't ignore in your risk assessment.
Absolutely. A definite yellow flag there. Let's pull these threads together and focus explicitly on the risks. Chapter 6. Risk Assessment.
Okay, if we're thinking SWOT analysis, let's focus on the threats and weaknesses. The biggest macro risk, tied right back to that valuation puzzle, has to be interest rates.
Yeah, that sensitivity seems key.
It really is. A significant portion of their high-margin income comes from interest on that $7 billion customer float. If global central banks start cutting rates, that income stream gets squeezed directly, potentially quite rapidly. That's a major headwind to profitability.
And then there's the geopolitical risk, those 2025 tariffs. We framed it as both a risk and an opportunity earlier.
Exactly. Dual impact. Short term, it's definitely a pain point.
Right.
About 20% of their revenue was tied to that China-U.S. corridor. The disruption was significant enough that they had to pull their initial 2025 guidance. So near-term headwind, for sure. But longer term, as we discussed, that forced diversification, the shift to Mexico, India, Vietnam, that creates more complexity. And managing that complexity is Payoneer's bread and butter, so it could be a significant long-term tailwind, making them even more essential.
Makes sense. And finally, we have to come back to those internal weaknesses, the compliance history, and crucially, those ongoing customer service issues.
Right. The past compliance stuff, the NYDFS fines, that's a lingering reputational thing. It shows there were problems that needed fixing. But the persistent customer service failures, the account freezes, the terrible support documented in those BBB complaints, that's an active, ongoing execution risk. It directly damages the trust they need. They simply have to get that fixed. It's a fundamental operational gap.
Okay, a lot to weigh up there. Let's try to synthesize all this. Chapter 7. Conclusion. So, boiling it down. The bull case for Payoneer seems clear. You've got a proven management team that successfully pivoted to profitability. You have fantastic free cash flow generation, a rock-solid debt-free balance sheet, and these potentially powerful geopolitical tailwinds driving demand for their core service managing cross-border complexity.
Yep, that's the bull side. And the bear case. Well, it's anchored in intense competition, especially from players like Wise on fees. There's clearly execution risk, highlighted by all those customer service horror stories. There's this significant sensitivity to falling interest rates impacting that key profit stream. And of course, those conflicting signals from insiders selling shares even while the company buys them back.
So where does that leave the valuation? The current price, around $5.94, it feels like the market is acknowledging both sides, right? We saw conservative discounted cash flow models suggesting a value closer to $4.74, while a more optimistic one might reach $8.19. So $5.94 is sitting kind of cautiously in the middle.
Exactly. It seems the current market price is baking in a pretty significant discount for all that near-term uncertainty and the execution risk we talked about, especially the risk around that interest income. Investors are essentially saying, show me. They're waiting for proof that the core business earnings, the non-interest income from transactions and services, can grow fast enough on its own to justify that higher growth like PE multiple. They want confirmation that the low PFCF really is a mispricing opportunity based on sustainable core growth.
That really crystallizes the current situation, which leads us nicely into our final thought for you, the listener, to chew on. Think about the major trend across the entire payments industry. The push towards real-time payments, everything getting faster, potentially instant. How does that impact Payoneer's model? Specifically, that high-margin interest income they earn by holding customer funds.
Yeah.
If money moves instantly, there's no float to earn interest on, right? Could the demand for speed actually be the enemy of this part of their profitability? It's something worth watching.
That's a great point. And more broadly, just keep watching how this whole reordering of global trade plays out. It's creating a lot of new winners and losers, and Payoneer is right in the middle of it.
Definitely. And remember, if you want more deep dives like this one, subscribe to Stock Analytics AI. We cover the S&P 500, the NASDAQ 100 is next for members, and you can suggest stocks you want us to analyze in the comments. And finally, the important bit. This analysis was generated by an AI system. It's for educational purposes only. It is absolutely not financial advice. Please always do your own research or talk to a qualified financial advisor before making any investment decisions.